So I want to share a quick story that I thought was very interesting. So this is about Mr. John D. Rockefeller. If you don't know John Rockefeller, he ran Standard Oil. He was worth $900 million in 1913. Okay? To put that into perspective, that's 3% of the U.S. GDP at that time. That would be $600 billion today if it was 3% of U.S. GDP. Now, everyone does their math a different way, but he's one of the richest people to ever live, built Standard Oil. And then all these, you can see all the trickle down. These are all the companies after they broke up his monopoly. You can see on that nice slide there. These are all the companies that have survived today. John. I read an interesting book. I'd highly recommend this book. This is 38 letters from John D. Rockefeller to his son. Anybody ever read this book? I recently read this book for the first time. I'd never heard of it before. These are literally just letters that he writes to his son, John Jr. I think it's John Jr. And he goes through his life, and they timestamp him. You just hear these 38 letters, how he built his empire. 2 stories I want to tell you from here. I'll tell you briefly. Number 1, this is just a fun story. Now, John is kind of there's good stories about him, bad stories, whatever, but he's got this interesting, almost villain background story of how, like, his origin story. This is just for fun. I thought it was interesting, and I'll tell you the other one. But he writes in his letter to his son John about a picture he has on his desk that he keeps on his desk. And he goes, this is my most prized possession, this picture. I love this picture. And it's a picture of when he's a schoolboy with his schoolmates. He goes, the story goes, he was at school. He's 8, 9, 10 years old. A photographer came to the school to take pictures of John and the students. He grew up pretty poor. They were all very excited for this photographer to come. Photographer comes, and they're lining up all the kids to take a picture in front of the schoolhouse. Does that make sense? They're all lining them up. The photographer says, hey, can we get this little boy in the front that's kind of in the scraggly clothes? Can we get him out of the picture? He's going to ruin the picture because his clothes don't look very good. He's kind of run down. It's John Rockefeller, because he grew up in a poor family. The teacher removes him from the photo. All of his schoolmates get a photo. And that's the photo he has on his desk. And he said in that moment, he said, I will be the richest man to ever live. He says, I'm going to make so much money. I'm going to absolutely dominate my industry. I'm going to become that person that I'll never be kicked out of a photo again. But in his letter, this is years later, he goes, I don't look back at that photo with disdain at all. He goes, I love my schoolmates. I look back at it as a cherished time because it made me who the man I am today. And in the letter, he's like, I'm not sad about it. I'm not mad at that photographer. It turned out to be the best thing to ever happen in my life was that guy taking me out of that photo. Isn't that interesting? And just as a villain origin story, he has the photo still in his desk as he's like the richest man on earth, runs 3% of U.S. GDP. He has that picture, and I think about that a lot of us have. we can get on our soapbox here, but we have problems. You had parents, you had issues, you had everything, but all those things are made you who you are today, right? You got to thank all those problems you had in life. You have to also thank people for those problems. Thank you for giving me that problem because it made me who I am today. Yeah, can I get an amen? All right. So that was the first kind of story that was fun. Second story I want to tell you that was more kind of tailored to our topic today was because we're talking about scaling, right? So John, he was in Ohio. Cincinnati was his main spot, that was his hub. He had this vision. He wanted to be the dominant power in oil. There was a new competitor, a threat that came in Pennsylvania that was starting to build refineries. He was starting to send oil to New York. He was trying to sell to New York. And so what John did, and this is his letter to his son, so it's through his lens, but this is what he says happened. He goes, this person couldn't interfere with my plan to dominate the oil industry. So he goes, I set out a game plan. I set out a war plan of how I was going to approach and attack this. So he goes, step number 1, I offered to just buy their company. I just gave him an offer. He turned it down. I gave him a higher offer. He turned it down. So I said, fine, it's time to go to war. So he goes, I bought up a full strip of land across the entire state of Pennsylvania to block this person from building pipelines. He goes, I made all these farmers super rich, but he goes, it didn't work. He had already found a way around it. He had already built this pipeline. I couldn't do it. So he goes, I wasted all this money making these farmers rich. So then he goes, then I moved to phase 2. So then on phase 2, he goes, I called all my friends in the railroad industry and asked them, do not let him build pipelines over or under your railroads, and I will pay you to do that. But he goes, I was too late. He had already paid off the other railroads, so he was already now shipping oil into New York and was displacing me out of New York. Does that make sense? So he goes, I came back, I took my loss, and now this guy was becoming the top oil supplier, I guess you could call it, into New York. So he goes, I had to come back home and I had to regroup on how I would do this game plan. So what he does, he comes back and he says, all right, he goes to the manufacturer of, and I'm getting the terms wrong, but I think it's like oil barrels, like the big storage containers for oil. He goes, there's one manufacturer in New York that kind of supplied everybody. He goes, I put in the largest order ever. And I said, I'm going to overpay. You have to put me at the front of the line. You can't service anybody else besides me because I'm going to pay you so much. The supplier agreed. And so what happened was he bought all these extra barrels of, containers for oil, and this competitor couldn't buy them from him. He goes, that was phase one. Phase two, he goes, I went to the end users in New York and started to buy up the end buyers, their companies, so that they wouldn't buy from him anymore. And then he goes, finally, I lowered my price of oil so that anybody buying oil, I ran at a loss so they would buy from me instead of him. Pretty crazy. He goes, over a course of a few, number of months, we kind of bled this company out. I gave them an offer. We bought their company, and now they're part of our family, our Standard Oil empire. Isn't that a wild story? And he goes, in his letter, it's very interesting how he explains. He goes, I couldn't give up. He was interfering with my plans of being the dominant oil person of the planet. And he thought extremely out of the box to accomplish that. Now, you might love that story. You might say he's a villain, but I'm just telling you the story. That's just the facts of what at least he wrote in his letter to his son about what happened. I want to dovetail that story with another story here from Mr. Jeffery Bezos, okay? AWS is a company that was started in 2005, pretty much runs the internet today. Do you guys know AWS? Amazon Web Services. Let me give you a few stats on AWS. Some people don't know what AWS is. You have Amazon, like the store, obviously. AWS is the backbone of a lot of the internet. A lot of the servers, all the data, there's a ton of stuff they do. By itself, okay, AWS is 33% of global market share of the internet database space. They do $106 billion a year. This is a sub-company within Amazon. Estimated $1.4 trillion market cap. Pretty wild. This is AWS. AWS was started in 2005 by Andrew Jassy, and this is how they approach the market. It's much different than other people. And I'll go back to this slide. You guys have heard me talk about red ocean and blue ocean before, right? This comes from a number of books. There's Blue Ocean Strategy, another one called Play Bigger, talks about this concept. There are red oceans and blue oceans. In a red ocean, which is bloody, they call it red because it's bloody with water of imagine sharks, they're all eating, and it's a very competitive market. Statistically, 74% of market share in a red ocean goes to one company. One. So if you look at a great example is, online search, Google search, right? Who's the number one dominant player? Google, right? They own roughly 94% of online search on the internet. I've shared this before, some of you guys know, but Bing, for example, Microsoft built Bing. They spent about $1 billion developing it, about $11 billion over the last 10 years on Bing. Today, Bing has less than about 2.5% market share. Really did nothing. From Microsoft. This wasn't some start. This is Microsoft building Bing. It's very hard to disrupt a category king once they have the category. Does that make sense? That's the concept here. So when you're building new businesses, these authors argue, you should build in a blue ocean, build something new and different. A lot of you probably know, what's the second largest search engine in the world? YouTube. Some of you guys heard me share this before. YouTube. It's not Bing. It's not Yahoo. YouTube is the second largest search engine in the world. It was a blue ocean. It was video search. It grew up into a red ocean. YouTube dominates 90+% of market share. Google then bought YouTube because it was a category king. Right now, who is disrupting Google and YouTube as search? ChatGPT. Again, it's a blue ocean. This is a new ocean that's now emerging as, you call it AI search, right? So this is the concept of red ocean, blue ocean. So Mr. Jeffery Bezos understands this well. So with AWS, it's very interesting how they launched this. So they wanted to launch it. Most of us would launch a product, try to get good margins. This is a brand new opportunity and build from there. This quote here on the right this is a famous Jeff Bezos quote. He goes, your margin is my opportunity. Your margin is my opportunity. I'll give you just rough numbers, but if everyone was charging $1 was break even. People are charging $1, 5 cents, $1.10, $1.07, right? That's the competitors. Jeff Bezos charged 97 cents. He ran AWS at a loss for a year, 2 years, 3 years. Then it was barely break even, 4 years, 5 years. And what happened is he sucked in the entire market share because it was the best deal out there. And everyone, we can't compete with Jeff. Why? Because he was running at a red for years to grab market share, to be a category king. And then from there, what does he do? Once he has market share, he raises prices. They've run very profitable business, obviously, $106 billion in revenue, $1.4 trillion market cap. Trillion. So today we're talking about playing bigger, playing business at a different game. I shared this with a group a few weeks ago. All of you know this, but you're in Black Card. But I shared this with a group that wasn't doing funds. I was like, a lot of us, and I was talking to this group, they were asking about, hey, I want to go buy an HVAC business, or I'm going to buy a couple HVACs and pull them together and grow. And I said, what if someone with a fund comes to your town, buys up all the other HVAC companies, drops their prices for the next year below yours, so they suck in your market share and bleed you dry? What are you going to do? And they're like, I don't know. That sounds blah, blah. I'm like, I'm just telling you stories of. It might be right or wrong. You might be mad about that, but that totally can happen in this marketplace. You need to think and play bigger, or else you might be subject to someone who did think and play bigger. In certain areas of the country, there are funds that take over investor pool markets. The good thing about us with funds is we can get different pools. We have high net worths, family offices, institutions, and funds are limited to how many investors they have, but there are category kings of those markets. How can you position yourself to not be a Me Too product, but how do we position you to be something not better, but different? Back to the example of Bing and Google. You don't want to just try to be, we're going to be a better search engine. We want to position your funds to be different, like YouTube or ChatGPT, and pull market share from other places into your businesses. Sound good? Can I get a yes?
Yes.
All right, sweet. So that's how we're going to frame today. Should be pretty fun. So my goal for this event is we're going to help you scale your fund. So we've traditionally talked about the fund launch formula in 4 phases, right? Step 1, find your deal. Number 2, frame. Number 3, capital. Number 4, legal, which is still true. I still love the fund launch formula, but the graphic of like 1, 2, 3, 4 didn't make sense because I really taught it in a circle. I was like, you do 1, 2, 3, then you go back to 1, do 1, 2, 3. So we said, why don't we just draw it that way? And so we have the whiteboard. We spent a few months actually working on this. So this is, if you can see this is what I'm going to call it the new fund launch formula would look like. And then furthermore, we expanded this and kind of made terms more clear. So you can see here, same as before. Phase 1, you're working on your deal/strategy. So what's your thesis? How are you building, how are you finding asymmetrical risk in your fund? Okay. Phase number 2, frame and structure. How are you actually going to structure and frame your fund? So this would be your pref, catch up, all the mechanics of how your fund's going to work. After that, we go to capital/verbal commitments. We're trying to get validation on our fund. The fund launch formula is built for entrepreneurs. I have a friend, he did not follow this. He spent about $500,000 launching his first fund. Because what he did was he went to legal first. A lot of people are like, okay, I'm ready to launch my fund. Give me the lawyers. That's what he did. He went and talked to a lawyer first. Then he went and talked to people. Investors gave him feedback. He tweaked his deal and strategy, tweaked his frame, and lawyers billed him $800 to $1,000 an hour to tweak and iterate his fund over and over and over again. His fund the scope was like, it was going to be 50 grand, then it was 70, then it was 100, then it was 120, then it was 180, and it literally got up to around $500,000 he spent on pieces of paper for his first fund. Now I talked to him, he's like, it worked out. He raised like $100 million on that first fund. So it was fine, but still it's pretty expensive. He's like, I wish I would have had this when I launched that fund. So what we invite and teach all of you guys, and our whole platform is built around this, is number 1, work on your thesis, your deal, frame and structure, and capital in tandem. Work on all 3 of those. I love this quote. I don't know who said it first, but I love the quote of, if you ask for capital, if you ask for money, you generally get advice. If you ask for advice, you generally get money. What I'm encouraging y'all to do, and myself included, as you do this, ask for advice. Call people up. Hey, I'm looking to put together a fund. Can I get your advice? I know you look at a lot of funds. Can you spend 12 minutes with me? Give me some advice on how am I barking up the right tree? Yeah, people love to give advice. Yeah, if they're a mentor, friend of yours, great. Hop in, okay, and you give them the real pitch. Give them the full pitch. And one of two things will happen. They're going to give you some great advice that you're going to go back to phase 1 or phase 2 to tweak. Or they're going to go, hey, is this a real thing? Are you actually, yeah, I'm putting this together. Give me a few weeks, but hey, if this thing actually comes together, I'll put some money in. We've raised a ton of money doing that. Again, I love asking for advice, but when you go ask for money, a lot of times you get advice. It's pretty interesting. Sound good? Can I get a yes? All right, I put a line here for validation. Shout out to Jackson. He was like, we got to put this line here. What you're trying to do here is get validation. That you're crossing over validation. You have validated that your fund idea is actually good. I can't tell you how many funds build great legal docs and then never launch, never get to a first close because no one wants to invest, because they didn't actually validate that people even wanted this thing. Am I making sense? So we're crossing that barrier to validation. Then we're moving to legal. Okay, that's legal and formation. So then we're doing the legal. We do all the stuff in legal. We're launched. Now, currently, fund launch has been very focused on launching funds, right? We're fund launch. That's what we do. We launch your fund. We help a little bit post-launch, and we have stuff about that, but we didn't have full frameworks around post-launch until today. Okay, drum roll, please. I guess a lot of you guys haven't seen this. So drum roll, please. Give me a little drum roll. This is post-launch. Okay, this is what you're doing for the rest of your life. Post-launch. Okay, you are going now to the capital markets. You are striving for a first close. You're getting money in for a first close. You're then, after your first close, doing asset management. You're acquiring, you're buying, you're building. You're then building out your firm. So you're building out interns, staff, people around you, and then you're raising capital again. You're doing this in a loop pretty much forever. You're raising your second close. Then you get to your final close. So Fund Launch Partners, for example, we did our first close. Lincoln, when was our first close? Last March? Last March, is that right? Okay, first close was last March here. So we did a first close. What was our first close, Link?
1.2.
So we're trying to raise $30 million. We closed 1.2 on our first close. First close, we then actually started deploying that in little chunks. As we did that, we started to build a little bit of firm, and then we were striving for a second close. And we did a second close. We got a few more $1 million in. We bought a few more assets. We then went to firm management. We built out our team a little bit more. We then kept going. Third close, fourth close. Our final close, it took about, I guess that's from first close to final close, was from March to March. Our final close, we brought in roughly roughly 30 million on that final close. And now we are not raising money. We're in full asset management and firm management. Now we're deploying Fund Launch Partners. We have 2 more deals under LOI, I believe, right now. We're trying to do about 17 to 19 more deals in the next, 24 months, something like that. Average deal is about $1 million, about $1 million commitment, which is pretty cool. We actually reviewed a couple deals of BlackRock members the last few days. I think we approved 1 or 2, didn't we, Link? Something like that. At least approved to move forward on further due diligence. Pretty cool. Fund Launch formula. So as you cross over these, you cross validation, you then cross launch, you filed your Form D, you then push to a first close, and you're doing this forever. So even when you're running your massive, huge fund, you're still always raising capital, you're always doing asset management, and you're always doing firm management.